Welcome to the Deep Dive, where we cut through the noise to bring you the most potent nuggets of knowledge. Today, we're diving headfirst into the colossal, yet often misunderstood, world of foreign exchange, or Forex.
It really is. It's the market that forms, the very bedrock of global trade, far bigger than stocks or bonds. And as we unpacked it today, you'll see it's also one of the most dynamic and surprisingly accessible financial landscapes, especially for anyone keen to understand how global events ripple through currency values.
Yeah, absolutely. We've pulled together a comprehensive stack of sources for this deep dive. We've got stuff from Investopedia, Wikipedia, Think Markets, Blueberry Markets, and Swissquote too. Our mission is clear: to equip you with a rock-solid understanding of what Forex is, how it actually functions, what truly drives its movements, and even how people like you and me engage with it every single day.
Exactly. We'll navigate everything from the mind-boggling scale of this market to the specific language it speaks terms like pips and lots. Then we'll connect those mechanics to the major forces influencing currency values and explore the diverse ways traders actually approach this fast-paced environment.
Right, so if you ever found yourself wondering how currency exchange works beyond just buying vacation money, or maybe how a central bank's decision halfway across the world impacts global economies, well, this deep dive is absolutely for you. Okay, let's unpack this. So to kick things off, let's establish the sheer magnitude of Forex. What exactly is this market, and just how enormous are we talking?
Okay, so Forex or FX, it's the global market where currencies are traded. But unlike a stock exchange, there's no single building or central location. It's not like Wall Street. Think of it more like
Oh.
people trading directly with each other all around the world, creating a continuous, always-on exchange. And what's truly mind-blowing is its scale. It is the largest financial market in the world by trading volume. Absolutely dwarfs even the credit market. To give you a concrete number, in April 2022, the average daily turnover was a staggering $7.5 trillion.
Wow, 7.5 trillion.
Trillion. Just imagine $7.5 trillion exchanging hands every single day.
That's almost hard to wrap your head around. So, given that massive volume, I imagine this isn't a market that just closes down for the night like a stock exchange, right?
No, that's a critical distinction. Because it's a global over-the-counter market, it operates continuously, 24 hours a day, 5 days a week, kicks off Sunday evening in Sydney, runs right through until Friday evening in New York. And this continuous operation, well, it contributes to its incredibly high liquidity.
Liquidity meaning you can trade easily.
Yeah, meaning you can almost always buy or sell a currency quickly without, significantly impacting its price.
Fascinating. So how do currencies actually get traded then? It's not just one currency in isolation, is it?
Not at all. Currencies are always traded in pairs. Like EURUSD is a really common one. The first currency listed, that's the base currency, and it's always equal to 1. The second is the quote currency, and it tells you how much of it you need to buy 1 unit of the base.
Okay.
So for instance, EURUSD 1.0500 means 1 euro costs 1.05 US dollars, and there's a common market convention here. The US dollar is usually the base currency in most pairs, like USD/JPY.
Right, dollar yen.
Exactly. But there are notable exceptions. The British pound, Aussie dollar, Kiwi dollar, and the euro are typically the base when paired with the USD. So GBP USD or Euro USD.
Okay, that makes sense. And what about those tiny movements in price? I've definitely heard terms like pips thrown around. How significant are they really?
Pips. PIP stands for price interest point, and it's the smallest standard unit of price movement. For most currency pairs, a pip is like a tiny, tiny step. It's 1/100th of 1%.
Okay, tiny.
Yeah, appearing in the fourth decimal place, so 0.0001. If URSD moves from 1.1275 to 1.1276, that's just 1 pip.
So is there an exception for currencies like the Japanese yen? Because those quotes look different, fewer decimal places.
Good catch. There is. The Japanese yen is the main exception. JPY pairs are quoted with only 2 decimal places, so a pip is in the second decimal place via zero point zero 0.01. And for even finer measurements, sometimes you'll see pipettes, or fractional pips.
Okay.
Yeah, they measure the 5th decimal place, or the 3rd for yen pairs. Basically 1/10 of a pip. Used for really precise tracking, but honestly, usually not something beginners need to obsess over right away.
It sounds like you'd need to trade an enormous amount of currency, though, to make any meaningful money from such incredibly small movements like pips. How do traders make those tiny changes add up?
You've hit on a crucial point there. That's precisely where lots and leverage come into play. Currencies are traded in standardized batches called lots. A standard lot is 100,000 units of the base currency.
100,000.
Oh,
Okay, that's substantial.
it is. So suddenly, that small one-pip move on a standard lot can actually represent a significant amount of money. And then there's leverage. Leverage lets you control a much larger position with a smaller amount of your own capital.
Right, like a multiplier.
Kind of. For example, if you have, say, $5,000 in your account and your broker offers 30 to 1 leverage, you could potentially enter positions worth up to $150,000.
Wow.
Yeah. Now, while this obviously amplifies potential profits, and this is critical, it also amplifies potential losses just as much.
That sounds like the risky part.
It absolutely is.
Yeah.
The key insight here is that while leverage makes trading accessible with smaller capital, it's also probably the single biggest reason why many new traders fail. It's often not because they're wrong more often, but because one big, over-leveraged move can wipe out their capital.
Yep.
And a quick note on the spread, that's essentially how your broker makes money. It's that tiny difference between the buying price and the selling price of a currency pair. A bit like the exchange fee you see at an airport currency counter, but usually much smaller.
Got it. So, with trillions changing hands daily, who exactly are these diverse players? Is it purely big banks moving all this money?
Well, the big banks are certainly a huge part of it. It's a vast ecosystem, though, with lots of different players, each with distinct motivations. At the very top, you have the largest commercial banks and securities dealers. They form what's called the interbank market. They move staggering volumes, mostly amongst themselves. But beyond them, you see large commercial companies like multinational corporations. They're actively participating to hedge their currency exposure.
Hedge, meaning protect themselves.
Exactly. They buy or sell currency to protect their business from adverse fluctuations in exchange rates, help safeguard international trade deals, or even just making payroll in different countries.
And central banks, like the Fed or the European Central Bank, they must play a substantial role too, right?
Oh, immense. Absolutely. National central banks are major players. They use the foreign exchange markets to manage their country's money supply, control inflation, influence interest rates, basically steer the economy.
Yeah.
They can even deploy their substantial foreign exchange reserves to stabilize their own currency's value. For instance, by buying their own currency if it's falling too fast.
Yeah.
And then you have investment management firms. They facilitate transactions in foreign securities for clients like pension funds. Some even have their own specialized speculative currency operations.
What about individual people, like our listener, the learner, for example?
Yeah.
Can they get involved in this massive market?
Definitely. Individual retail speculative traders are actually a rapidly growing segment. Now, they participate indirectly, usually through brokers or banks, but collectively they contribute significantly. One estimate back in 2010 put their share at up to 10% of spot turnover, which was like $150 billion per day even then.
Wow, so individuals do move the needle.
Collectively, yes. And beyond pure speculative trading, you also have, non-bank foreign exchange companies for currency exchange and international payments. And even the money transfer places, remittance companies, bureau de change, they handle those lower value physical currency needs, especially for travelers.
So, okay, for most of these players, especially the individual retail traders, what's the core motivation? Why engage in this market?
Well, while a lot of foreign exchange happens for practical reasons, like that international trade facilitation we mentioned, the vast majority, probably around 90% of currency conversion, is actually undertaken by Forex traders specifically aiming to earn a profit.
90%. So mostly speculation.
Mostly speculation, yes. Predicting whether one currency will strengthen or weaken against another and then opening a long, which is a buy position, or a sell position accordingly. But another key reason, especially for businesses and large investors, is that hedging against risk we talked about.
Right, the protection aspect.
Exactly. If you're a company expecting payment in euros in 3 months, but you operate in dollars, you might enter a forward contract today. That locks in an exchange rate now, protecting you if the euro weakens against the dollar before you get paid.
That makes perfect sense for businesses. But for an individual, it sounds like the big draw is being able to profit from prices going down as well as up. That's quite different from just buying stocks. Is that where the real speculative opportunity lies?
Precisely. You can be bullish, expecting a rise on buying, or you can be bearish, expecting a fall and selling. It allows for really diverse strategies in all sorts of market conditions. It opens up many more avenues for potential profit compared to markets where you typically only gain when the price goes up.
Okay, so we have all these different players, different motivations, trillions flying around. What actually makes a currency pair move? What are the biggest drivers influencing these exchange rates day to day?
Right, it's a complex interplay of factors for sure, but they generally fall into three key categories. You've got economic factors, political conditions, and interestingly, market psychology.
Hmm.
Think of the world's currency markets as this huge melting pot, constantly shifting based on these influences, reacting to them in real time.
Let's dive into the economic factors first then. What's most important there? What are the absolute foundational elements?
Okay, the overall economic health of a nation is paramount. That's number one. And within that, central bank interest rate decisions are hugely influential, really, really key. When a central bank raises interest rates, it makes its currency more attractive to foreign investors looking for higher returns.
Because they get paid more interest.
Exactly.